Hello everyone, good evening. Um, on behalf of ICI, I welcome you to Sky has Symposium. Today's speaker, sorry, for the first speaker today, we have CA Meera Joshir. CA Meera Joshir is a highly motivated, adaptable, and responsible senior chartered accountant. She, she is backed by diversified experience of more than a decade and a half and is associated with the firm RC Jain and Associates more than 13 years now. She is the face of the firm at several professional and training portals to present and share the rich experience she holds working in a very organized fashion. She is always cognizant of quality and cost, qualities like high confidence, hard work, and zeal to learn new things, kept her on her feet even during her stay in the UK for nearly 4 years, where local laws did not allow her to work as a chartered accountant. She worked with a leading bank and indeed excelled in that as well, besides obtaining a diploma in IFRS from ICCA UK certification in intensive course for service tax. She's been on a continuous journey to learn and keep her updated real time. Team spirit and leadership being key strengths, she definitely is a reliable and trustworthy pillar of the firm. Her areas of specialization are statutory assurance and risk advisory, particularly in the field of banking and insurance audit, internal audit, process audit, tax audit, trust and society audit, provident fund audit, internal statutory and third party, international taxation and cross border advisory, structural planning. She has led several presentation programs for the following. She has contributed as a reviewer to the ICI publication on beneficial state of policies for women welfare, a one-stop reference material for benefits provided by the various state governments to women and girl child. She has also contributed to Bhanushali Chartered Accountant Forum, where she has conducted various several online and offline sessions on direct taxation and audit. Saksham, a live webcast by Women Empowerment Committee of WRC on emerging professional opportunities. Prerna Women's Conference at Thane branch of WRC panel discussion on internal bank audits. Well, that is short form for Women Entrepreneurs Learn to Lead, where she has displayed Indian AS series. Mulund Study Circle, Women's Wing of JB Nagar Study Circle, ICFR. Various WRC branches, including Vikasa, where she has done online and offline sessions on bank branch audit, tax audit, role of women CA, and opportunities for women CA, etc. She has worked with different clients like Nuclear Power Corporation of India, New India Assurance, Anthony Group of Waste Management, Nirmal Group of Builders, Everest Group of Builders, different on different topics. She has also had sessions with National Insurance Academy Pune, frequently faculty for training insurance staff on statutory audit of operating offices, insurance, and GST implementation thereupon. She has also contributed on various professional circles like serving WRC as a coordinator for various sessions and courses, co-opted member of Women Empowerment Committee of WRC and WMEC Committee of ICI, member of Core Committee of Women Entrepreneurs Lead to Lead, members of Core Committee of BCF, that is Bhanushali Chartered Accountants Forum. She has also been associated with various clients such as New India Assurance, Nuclear Power Corporation of India, Mahanagar Transmission Company Limited, National Insurance Academy, Mahanagar Generation Company Limited, National Insurance Health Mission, Mahanagar Distribution Company Limited, Indian Institute of Packaging, Mumbai Aviation Fuel Pump Private Limited, Anthony Group of Waste Management, MSEB, and several other listed CPF funds, Kamatgiri Fashion Limited, Ircon International Limited, and various banks such as SBI, Union Bank, Bank of Baroda, Bank of India, Central Bank, Canara Bank, Dena Bank, Vijay Bank, Syndicate Bank, United Bank. The list goes on. Uh, it is a like we are happy that she is going to share her views on a peer review. Over to you, Meera.
Thank you so much, Ishita ma'am. Introduction was pretty long, but I'm very happy that you've given me such a warm welcome. Uh, Thank you, Women Empowerment Committee of ICA, who's given me this opportunity today to share my views on peer review, how much and why, and that introspection is required. Maybe that topic would sound quite bland or uninteresting, but I'm sure at the end of the session, at the end of 35-40 minutes, you will feel it was very much necessary. So let us get through immediately. I'll share my screen. Peer review, a must required introspection. Many of you would already be knowing the concept of peer review, which ICI has introduced actually way back in 2004, but we were not using it as much as was intended for. It's for last 8 to 10 years that it has gained momentum. And basically, we have started reaping the benefits of what the visionaries have basically plowed in or sowed into our system. Let me put through the main object. Yeah. If I talk about objective of the system of peer review, I can just read it out saying it is to ensure that carrying out the assurance assignments, we, the members of the institute, comply with the technical, professional, and ethical standards, including the regulatory requirements, and have in place a proper system, including documentation thereof. And more than that, the most important, to amply demonstrate the quality of assurance services. See, here we all know and we all are following our technical, professional, and ethical standards. We are day in and day out are on our toes to ensure that we provide a good quality assurance service, not only to our client, but to society at large. But what do we miss on is to amply demonstrate that this quality really is into existence. Today, if you see, every vigilance department is behind the chartered accountant fraternity like a watchdog. Everyone is behind us on where we are defaulting, what kind of mistakes that we are doing, so that they can hold us responsible. And somewhere or the other, I would not say it is completely wrong, because they have so much of expectation from us that we really need to be that vigilant, that sharp and alertive, and we need to also raise that warning alarm to the society wherever things are going wrong. Now, what happens is, in our journey of assurance services, in our activity, we do demonstrate a very good quality approach, a professional approach, but we may lack on a couple of activities. One, maybe the partner is very good, the senior is very good, but the articles are not that sharp and knowledgeable to catch hold of the issues that are pertaining in that respective entity. Or maybe the entire team is fantastic, but they have failed to follow a right approach, a right method, a right pathway, as a result of which we end up making some mistakes and end up not reporting something which was important, right? And I would say one step further, most of us even do that. We do the best of our work, but there was something which was purposely hidden from us. We were not being able to find out in fact because they were actually dug below the earth, right? If the management is smart enough and they are not able to, they are able to hide so much of it, to what extent we can go and check it? We have certain limitations, and those limitations we do put it across in our audit report also, that our audit report is subject to these restrictions or these kind of, we have these limitations. But what happens is, in spite of that, we are held responsible. We are held responsible for not bringing out certain aspects. So what do we do? As a tool of peer review, what the institute has tried to put into system is that when we as chartered accountants are performing our duties, we not only perform it to its best, but we also ensure that we have adequately documented it, demonstrated it, so that tomorrow, in case there is anyone who charges us with any kind of negligence, we are able to prove that we were not wrong in our stance. We have displayed the best of professionalism, the best of independence, but it was something which was beyond our reach, and that is why that was left behind. So we need that demonstration, we need that documentation, and that is why the emphasis on why peer review is required. And through the session, I will run through when it is required, why, and if at all it is not a must, what should we do, right? If I talk about my mandatory applicability, this is a list where it is mandatorily applicable immediately, or it is to be rolled out in the coming 4 to 5 years. Peer review is in place, especially in case of a listed entity and those kind of things, for last 10 years now. If I talk about myself, I have run through 3 peer review cycles, and that is basically why today I understand how important it is. The journey between my first peer review and the one which I just concluded last year, or the one which I just conducted a couple of months ago, has brought me so much of learnings that it was very important for me to share this with you all. What happens? We all know this is required. But so what? I don't have a statutory audit of an enterprise which is listed. I am not into an audit which is so big enough that it will create any impact, or I'm not compulsorily required to get myself peer review. But does the review system stop there? My question is that we all know that probably we do not fall in any of these categories. So what? Should we not get ourselves peer reviewed, or should we not conduct a peer review of ourselves? So what if it is not mandatory? I would just say peer review is a process by which a corroboration of goals of independence, excellence, and integrity being pursued by the professionals like us, this can be achieved. Now, how can we achieve this, right? I would say even if we are not peer reviewed, we are expected to be independent. We are expected to give our excellent work. We are required to be integral. We need to give the best quality assurance. What happens is, then why peer review? See, when I talk about a learning in school or a college or even a CA professional exam, we are learning, right? We are learning, we are performing, and we are being better every day. But if that learning is not subject to an inspection or an examination, we become a little bit relaxed and lethargic on our performance, right? So that is why we have examinations. And that is why peer review is like an examination, if not an external one, but an internal examination of where we stand. Are we really independent? If not, what should I do to become independent? Am I really giving an excellent and integral work to my client, to the society? Right? Peer review is a process which is adopted to meet the needs of a high quality assurance, consistency, and greater transparency. Now, if I talk about high quality assurance, definitely we are giving good quality, but we can still improve. Improve in terms of, if I have done 90%, I can go to 100%. If I missed on something, see, every day you and I are learning so much. We are learning in terms of knowledge gathering, in terms of experience, how to handle situations, how to dig out frauds, how to dig out unearthed or undisclosed details. But peer review is a process wherein you share your experiences. what happens is a chartered accountant is going to another chartered accountant's office, reviewing their work. So both are learning in the process. The firm whose peer review is happening is on the toes to ensure that I am sure that this independence is in place, because now someone is going to check that. I try to ensure that I have all my documentations in place. I have my working papers. I have all that is suggested by my standards of accounting. There are so many standards which guide us, which are like an umbrella for us to conduct our audit. But in the race or in my regular activity, I might end up risking my profession, risking my work by 2-3 aspects. One, I did not gain adequate knowledge. I went to a new industry, but I needed some X kind of knowledge to have before I could have started. But I may be compromised on it for XYZ reason. No one wants to do it purposely, but we might end up doing it. Right? So in such a situation, if I know that there is another colleague of mine, maybe equally or higher in rank to me, who's going to check my independence, who's going to check my knowledge on whether I was having adequate knowledge of that respective industry, whether my team was having that kind of edge to go and find and inspect their documents. If that, I would not say threat, but that kind of fear and internal fear at the back of the mind, it's there. So what we end up doing is we ensure that we have followed each and every standard of auditing. We have followed all the vigilance aspects which we were required, which we were expected to do. And hence, as I say, peer review is a nurturing tool to nurture the professional and through the professionals and profession as such. It is not an inspection. I mean, the approach is that of an examination, but it is like a teacher and student relationship, wherein the teacher is not one who is having a PhD, and at the same time, the student is not the one who is in kindergarten, right? Here, both are at par. So both interact with each other, both share their experience. This is what I am telling you. I just recently conducted one of the, I have been peer reviewed thrice. I conducted a peer review of an enterprise. I went there to find many more different practices which they had, which were better off. So I can incorporate that. So that is what I learned as a reviewer. When I did the inspection of their accounts, of their audits, what they learned out of it is where they were going wrong. What were the systems which were missed out? What happens is when I talk about documentation, we day in and day out end up missing out on maybe taking appointment letters, maybe documenting our independence, missing out on documenting the audit standards that we have followed. For example, it's a going concern, whether we have checked the entity is a going concern or not. Because if it is not a going concern, there are different standards of accounting. There are different ways I need to go and audit that respective entity. In such a situation, how do I ensure or how do I demonstrate that I have followed that standard, that I have checked that the entity was a going concern? So we miss out the documentation, and peer review really helps us introspect on what is that we are doing and what is that we are missing. There is a complete checklist on the board in the system, wherein they check on which are the standards I needed to follow, whether I've done that, whether the respective kind of training which was required to be given to my team. Because without training, without knowledge, if the team is just exposed to my client, the assurance can never be of a good quality, right? So peer review helps me document on, helps me as a checklist on what have I been doing. And once I expose my work to a peer reviewer, he will be guiding me as to this is what you have done, this is where you are missing. He'll share his experiences. So it is a nurturing tool. Let us take it as a nurturing tool. And even if it is not mandatory, I always personally suggest we should get it done. We have many options, whether we get it done through the institute, that is, we have a voluntary peer review system. Our first peer review, for example, was a voluntary peer review. We wanted to check our system. We wanted to check where we stand. So we approached the institute and offered our firm for a voluntary peer review. That is one option. The second option is wherein you can approach your colleagues and ask them to get your accounts audited, or not, I would not say account, to get your system, the audit system audited, the assurance system audited. It is a tool which helps us achieve self-discipline. In light of enormous amount of challenges that pervade the business world, the tool of peer review is required basically to upgrade our skills. To upgrade our skills on assignment basis, one, and to upgrade our skills with knowledge sharing with that reviewer, wherein I'm telling you, this is like my 5 to 7 experiences minimum of getting audited or auditing the others, wherein their skills or maybe some pattern of training which they were following really did help us and help our system to improvise, to devise appropriate system of work. See, here I would put across what happens is, if I talk about my journey into the chartered accountant firm where I am, my promoter partner right from day one, everyone in the office many a time says, sir, you always keep on talking about systems, whether the system is there, whether the system is followed. Why it is required? We are doing our work, right? We are doing our work diligently. We are doing it with hard work. But what he says, agreed, you are doing everything. But what if something apparently misses out your mind? If there is a system, if there is a checklist, if there is an audit program, if the system of mailing to the clients, if the system of training, the system of hiring people, the system of ensuring independence is there, if those are there in your system and the system is diligently followed, you will never miss out something, right? We don't understand the importance of a system to be in place. We always are dependent on humans. Work should not be human driven. We've always been trained for only one thing from our promoter partner. Don't let the work be human driven. Let it be system driven. If a human changes, for example, a team was led by ex-chartered accountant. She is fantastic. She has fabulous experience, fabulous knowledge. She's performed the assurance services, which even the 30, 40-year experienced chartered accountant would not have been done. But unfortunately, due to some reasons, she fell ill and chartered accountant Y had to take over. Now, the only mistake which X did was she did not document what she had done. So Y firstly struggled on what work is completed, what is pending, what are the kind of queries, which one of those are important. And when the work was completed by Y, it so happened that she missed out on updating certain parts. She missed out on certain crucial parameters, ending up into maybe charges of negligence, maybe some charge from the society saying that you are not independent. There are so many agencies. We have MCA, SEBI, RBI, NFRA, my public, everyone just having a sharp eye on what we are doing. They're expecting so much from us that at the end of the day, if we are not delivering, we are negligent and we are not satisfying their expectations. So we need to ensure that the work is system driven. Whatever work is done, there should be checklists in place. Everything should be on me. The letter of independence, letter of going concern, the letter of material risk that is identified, the kind of, I would say the, I mean, the population is there. We do a kind of test check. So the test check sample, everything should be documented. Tomorrow, if there is a question asking us what have we done, if we do not have these in place into our system, see, I always have a statement being referred to me that a habit never requires a memory space. If you want to walk, you are not going to give instructions to your brain, pick up the legs at 20 degrees, take it forward, keep it down, nothing. It is a habit. So my audit or my system in which I am going to perform my assurance services should be a habit. It should not be like I am doing it out of the way. It should be as if I am speaking, as if I am walking, as if I'm running. That easy and simplified it should be, and it is possible only one with practice and one practice of the right system. Peer review will allow me to ensure that I don't miss out on developing a system and executing it. Right? What does it help us? It helps us in developing and maintaining systems. I just said that. In conduct the work with adequate knowledge as well as independence. For example, we take an article or an assistant, we never take from them an independence letter as to this is the list of our clients. Are you by any way connected to that client? Right? We live in a, I would say, an atmosphere wherein we believe a lot. Whereas we should be like a police inspector who suspects everything. Right? So when that person is employed into your team, if I fail to systematically check his independence, later on it might happen that that person was related. And as a result, my assurance service was not up to the mark. He ended up not bringing to me some aspects which was otherwise required. I'm not going to check everything, right? How do I ensure? At least the maximum I can do is I can take an independence letter. When he's signing something, the one who wants to do fraud can do it by hook or crook. I am talking of a situation where at least an intentional thing is not come up, something that we don't miss out. Peer review will help us in only plugging something which is being missed out. Something which is intentionally plowed in, we cannot do anything about it. But yes, we end up doing mistakes. We end up missing out items, and peer review will help us in this. It will help us to ensure that we adhere to the various standards of auditing, the quality control, my review enterprises, my review engagements, my assurance engagements, etc. Right? And it helps document our work, my independence, my going concern, my materiality, my documentation of the queries that I discussed with the client. What was the kind of response I received from them? This needs to be documented. And if I know there is a third person who will check those documents, I will ensure that those documents are there. Else, what happens is we just miss. We do discuss, we do everything, but we don't save our skin. We don't have things on paper. So I would say peer review is something which helps and us do all of this. It is a strengthening tool. It is not a fault finding, but a knowledge sharing. As I told you, when a reviewer goes and reviews another firm, if the training of peer review is taken, it starts with that you are not expected to go and find faults in him. You are expected to ensure that he is doing what he is expected to share your experiences onto how the concerned colleague of yours can improvise something which unknowingly he is putting himself, risking himself for. Help him remove that. Help him mitigate those risks. Have an internal review system. Get periodically peer reviewed voluntarily, either through or without the institute, as I just told you. We have instances wherein, as I told you, my instance was wherein I voluntarily went to the institute asking for a independent peer review. I can also go to another colleague of mine whom I know or maybe whom I don't know. It is always better to go to someone whom you don't know. Ask him to get your systems reviewed. And though an external and formal review is definitely better, internal is, if not best, at least better than not doing it. We are presently not getting our systems reviewed. We don't know where our files are lying, what are the papers in our files. And at the time, many times you will find you don't even have, for example, if it is a GST audit, we do take appointment letters for a company audit. Why? Because it is required to be submitted to the MCA. We take trust audit appointment letters. Why? Because recently we are required to submit it to the trust office. We are required to submit the society appointments to the registrar. So we started taking those which are externally required to be submitted. But what about other assurance engagements? We do certifications. We do internal audits. We do LLP audits. There are so many. We do tax audits, GST audits. Many times we don't even bother to take a formal appointment letter. On just a call, we confirm that this is required to be done and we conduct it. Tomorrow, if there is an allegation onto why you did it, was I really authorized to do it? I have nothing to prove myself by. I have nothing to save my skin. And today, the negligence is, I would say, not only a fault, it has become like a sin. There are so many people to just hang you on why you couldn't do it accurately. The true and fair is there on paper, but we are expected to do a true and correct audit. A true and correct opinion is what is expected out of us. So save yourself, and peer review can help you do that. It is a sharpening tool. How come sharpening? As I told you, when I know someone is going to check what I'm going to do, so I will ensure that all the standards are followed. If I miss out any standard, it will just give me an alert warning. This is what you have not done it. This is the knowledge which my team required. I need to impart it to them. There will be, when I talk about systems, I need to have regular training sessions within my organization. I need to send them to outside training portals also, wherein internally probably I am not capable enough to give them that training. This is something which we know we should do, but we many times end up not doing it. So peer review will help you remind that this was required, this was expected, and have you done it? That tick mark, giving that yes, it is done. This is a checklist. So it will help sharpening us. It will help sharpening our skills. So it is like a two-sided effort. When I talk about peer review, I talk about two things. One, get yourself peer reviewed. And second is go and do peer review for others' work. Why? When you get your peer review done, you get an experience of a person who is coming to your organization. He will share his experience, his system, which is probably better, or maybe something which will help me improve. And when I go to another person, I see his entire office. I see just not one or two systems. When someone comes to me, I will guide on, this is something which you can inculcate. This is something which will help you. But when I am doing an audit of another firm, it opens me to an array of whatever they are doing. The entire office, the entire system is open to me. So I can share my experience and I can also gain a lot from them. So this is what I always did. Make both the efforts. Get yourself reviewed and also go and review. It is only then that you will be able to stand out in your work, that you will be able to ensure that you don't face negligence in future. Now, if one I talked about when it is compulsorily required to get your firm audited, when you can do it voluntarily. For the other part, the second part, who can be a peer review? So that if I need to go and do a peer review of another firm, can I do it? Yes, I can do it if I am a member in practice for the last 7 years, having an audit experience. In case a member has moved from industry, then I need to, if I am a person who's moved from industry, I need to have a 10 years experience, audit experience, and a 3 years of experience in practice. And I should have gone the requisite training. Peer reviewer, if I talk about, say 5 to 7 years ago, you were getting empaneled without any formal training. But as of today, the last 3 to 4 years, institute has started giving formal trainings. We need to appear for a test. And after that, we are eligible to be empaneled with them. And the entire process follows as to when I can go and peer review another entity. In light, and I would say, since it is a tool of self-discipline, I think this is a repeated. In light of the enormous amount of challenges or changes that are there, we need to get and conduct peer review to not only protect us, but also improvise on what we are doing. This is maybe the website, the website and the link of the institute, wherein you find all kinds of information on how to become a peer reviewer, my application forms, guidance on online tests. All answers to whatever questions come to your mind regarding peer review are available on this site. Besides that, you can definitely write to me on message, WhatsApp, and I can revert back with your queries. Any kind of questions which you would want to post now also are welcome. I halt my presentation here, and I will be happy to answer the queries coming from you.
Thank you, Meera, for this wonderful presentation. Like, it was so good. We we are not having as such any questions.
No issues.
Um,
You want me to take up anything else related to this? I have not attempted to cover what exactly peer review does, because it is a subject in itself. The peer review training is approximately like 2 to 3 full day trainings that we are conducting. The institute is conducting. So definitely covering that in a session of 30 to 40 minutes is next to impossible. So I have not covered anything about what peer review exactly is and how we actually conduct it. But my topic, as it said, why that introspection is required. And I sincerely believe, I think most of us don't give any weightage or are not at, I would say, we don't consider that institutes move that seriously. Today also, if I talk about peer review, not many of us are interested in getting it done. But when I have got it done for my firm, we really understand the benefits. And that was basically and precisely why this topic was designed today, because I sincerely feel we all should get it done.
uh, Meera, like, is it okay? Can you share few of the instances, like, people may more connect, like, this is the thing which had really cropped up, and this made you realize how peer review is really important. Can you, if possible, share
Yes,
some
I
instance
would.
or something?
Yes, I can share those. See, what happened is, the first peer review when we conducted, it was a voluntary one. We were not that prepared. So what happened is, we ourselves found that, as I told, the tax audits, the GST audits, at that time VAT was there. In those kind of audits, we never had even had appointment letters. So later on, when there are questions coming to us, and in what capacity have you done? So we couldn't actually display that. We couldn't demonstrate what was our capacity in conducting those kind of audits. Then, as far as sharpening tools are concerned, for example, what happened was, at that time, there was this Maharashtrian senior gentleman who had come for audit. We did have systems, no doubt we had systems, but we never documented. For example, this going concern, if I'm talking about going concern, this was a very recent, not even the first peer review, this is a very recent one, I think around 3 years or 4 years back. And after that, this COVID struck in. This year, when we were conducting our peer review last year, 2021 was the third one. He did question us on, he, after COVID, there are so many enterprises, and practically when they were conducting this peer review, they came up with, see, these are the negative balances. My capital itself is going negative. So how can you still continue saying that my in my audit report I just blindly, many a times it happens. In case of bigger enterprises, we do follow all the systems. We have going concern check, we have independence check, everything. But in this case, we had missed out somewhere or the other on checking that the shareholder fund had gone negative. Since this was a corona period, there was so much of turnover. My systems, we all went from physical to online. And in the year 2020, we actually couldn't follow this. So my team heads were not, I mean, when they were conducting audit, one of the instance in my case only, when I was conducting the audit, I missed out on the final review. There is a final review sheet wherein the quality control sheet which I talk about, wherein I see whether this is done, this is done, this is done. There is one part wherein you see whether the audit report is reviewed by me or a senior chartered accountant, the senior member. Apparently, before we could actually review it and send it, in the paucity of time, we just gave an instruction to the team that you send it across. Later on, we realized we had not checked it, and my audit report, which was submitted, apparently did not contain all that was required. Later on, there were charges. I mean, not, I would say, an allegation kind of, but we had a tough time when there was a second review done, and they found out that the report, this part of the report got missed out, and it happened just within a span of 1 month. So by the time I could recover out of my health and check what was done, that authority did point out, asking why these pointers are missed out in the audit report. To later realize that the senior member had not done the review of the audit report. The report which was sent across, due to my bad health, I did not read it. I just signed it and sent it. And it did cost me so much of shame, because later on when that authority pointed out, it became like, I did not even check this. I had checked it. The mistake was I did not do a finally QC. This QC was then pointed out by the reviewer. Ma'am, it was easily identifiable. Before any work is signed, no, ask your team member to fill in the QC, fill in the name of the people who have done those respective activities, and only after reviewing all that, once you're satisfied, do sign the report. So my belief or my reliance on the team should not, I'm not saying that I should not leave, but when it comes to quality check, at that point, only system should work. No belief, no assurance, nothing. No personal emotions should come into picture. Only paper should speak. Only then I will say that the mistake will not happen. It was a mistake, but you imagine a third party asking and charging a chartered accountant on, how come you missed on these simple things? It feels so insulting, and giving those kind of explanations to the others. So that is the reason I found, yes, now this quality control sheet, probably which we did check, but we never had it on the system. We didn't have it in writing. So my peer reviewer, when he shared his system, and I found it so appealing that I have started incorporating it in all our audits now. So now before that sheet is signed, we generally don't sign off the balance sheets.
That is like quite interesting, and it happens with most
excuse me.
Yeah.
I have a doubt. Can I ask a doubt?
Yes.
Yeah. This is Nandini. Hi, Ms. Meera. Your session was really good. I just have a doubt.
Yes.
See, the point taken. Yes, we should. All of us, as you said, know that these are things that has to be signed, checked off before signing off a balance sheet. We all have a QC list, and we have the systems in place. Everything is right, but see, like say September, October, we have certain deadlines. You need to complete a statutory audit for meeting off those deadlines before that time, and how things work. It's not just us. We can plan our schedules, but the client also has to cooperate. So we have all these due dates coming in place. In that kind of a situation, even if we have systems in place, and if we know very well that these things have to be checked before signing off, we end up signing in a hurry because of these deadlines and external pressures. So could you just throw some light on how we can work around these due dates and schedules, and also not missing out on these important aspects of documentation, other things? Because most of the time it comes like after you complete an audit and sign off, you go and back work on the documents. We would have seen, as you said, we would have seen all the documents, we would have done the audit as per whatever has to be done in the proper way, but the document should speak. So the document will be sometimes prepared post your signing a balance sheet or something, also because of the time pressures. So how do you think we can work around this before signing off a balance sheet to safeguard ourselves, as you said? Because sometimes we might miss out on very pivotal and important aspects in this time pressured
Yes,
scenarios.
I completely understood what you are trying to say, and that is exactly what we are facing. That's what I'm telling you. See, initially, what we used to also do is we used to conduct those audits, and after that, the postmortem is happening even when we do our internal. After the first peer review, we started that practice that after every season, we will check what we have done. We'll put all the papers in place. Whatever papers are missed out, we have a good rapport with the clients who will get those papers. We'll put it in the file. Lately, slowly and slowly, it started being imbibed in my system. See, it is like a difference between a child is learning to walk. So when he is learning to walk, his brain needs to process so much. It's telling you, pick up your leg, take it in forward. I mean, let us not go about walking. Let us do driving, right? If I talk about driving, when I'm learning to drive, I need to see the front, I mean, the center mirror, the right mirror, the left mirror. Then I need to check whether there is something, and the clutch is right, the gears are right. But 2 years down the line, 10 years down the line, do we need to give in those instructions to our brains? It comes automatically. So it is something which we need to imbibe in our system. After the first peer review, what we learned was that this post-mortem is happening. It is not going to help me. So after every year, we do this internal checks. In the internal checks, we do an introspection of where we are going wrong, which are the kind of documents which we are still missing out. I train my team again. Every year we have an internal peer review session wherein we train them on, see, these are the documents which you need to maintain. This is the filing system. First year it did not help. Second year did not help. Even after, I would say, 8 years, the 2 year gap of Corona really shattered away everything. It shattered badly. But had that 2 years not been in place, we were far better than what we used to do earlier. We started imbibing them. So now what happens is, now they create working papers as they are working. They maintain the query sheets in writing. They put up the queries to the client on mails. So this will happen only if we start doing it every day, if we practice it, rather than only as I would say, a system wherein we bring it on paper. It should not be like that. We should practice it every day. In every audit, in every assignment, we should ensure that it is in place. It's when it starts getting automatically been. Even in work pressure, we don't forget to eat, we don't forget to breathe. It should become like breathing. And it will take time, but it will happen only and only if we take it up seriously and if we do it every day, every hour.
I get it. Thank you.
Yeah.
Can I just ask one question? Like when you
Yes.
went for the first time for the voluntary peer review, was it difficult? Like how was the process and all? Like
That experience, very frankly, it's been like 10 years, but I still can't feel that. I mean, I can't forget that experience. Why? The reviewer is sitting in front of me. I mean, for example, there is a principal sitting in front of me who's asking me, where is this document? Where is that document? And I don't have those. I mean, at that time, the statutory audit appointments also, were not required to be uploaded on the FCA website, right? So even for statutory audit, we had missed out on taking those appointment letters. So when the reviewer is asking me, where is your appointment letter, and I don't have an answer, I can't go and tell him that Arey, main to bhul gayi. So it was like we used to tell him that I'm searching in my file. I used to ask 5-7 people to go and search around. In the meanwhile, what they are doing in searching is, one is preparing, the second one is sending it to the client, the third one is going to the client place, getting it signed, bringing it back in an hour's time.
Yes.
So this is the kind of difficulty we really face, and which made us realize that now we will have to have system in place. We'll have to ensure that these checklists are there. I have a filing checklist, which on a periodical basis internally I have to check. And when I check it every year, now my team knows. If it is not, then I'm going to shout at it. So now they'll also ensure before starting that the appointment letter is there, the NOC letter is there. When they are checking the financials, the program is made at the time of, I know, making an audit program of an assignment 3-year-old. I don't know who was working on it. I don't know the team leader. I was not involved, right? So making an audit program, making a query sheet for that kind of assignment was like a nightmare. But yes, that was voluntarily one, and it helped us improve. It helped us understand where we were standing, how much we were risking ourselves.
Thank you, Meera, for this wonderful session. It was really empowering and more of eye-opening. The way you explained that peer review is nurturing. The main concept is nurturing you as a professional by professional in a professional way, and especially how we learn on the process. Like, it is a habit forming. Like, first time is
Exactly.
difficult, then it becomes more difficult. And when we are doing peer review and getting ourselves the both side experience also makes us much better. I know they help us be a better as a professional. So thank you a lot for coming here and sharing your experience and uh, making peer review interesting thing, and hope further more firms will come up and do peer review and we'll have a better professionals and more ease in their life since everything is a bit streamlined. Thank
I
you so much.
sincerely hope this happens because it is the, I would say, need of an hour. We all are doing fantastic work, but we still day in and day out are facing so much of questions all around that we need to save our skin. It is not that easy to practice anymore.
Yes, yes. Thank you so much once again. And I would like to invite Nandini Subramaniam to please continue.
Thank you. So now we had a wonderful peer review session. Now we are going on to the next session of the day. Let me introduce our speaker for the next session, Ms. Pratima. Pratima has completed her chartered accountancy in 2012, and she has 13 years of experience in audit and assurance field. She has done her articleship with PwC and is currently an associate director with DSR, which is a member firm of KPMG. She has a huge experience in audit and assurance fields in FMCG, automotive, and technology sectors. She's been significantly working with respect to listing and other activities relating to both India and US IPOs. And she's also into reporting in both Indian IFRS, Indies, and US GAAP. So we have Ms. Pratima here with us today, who's going to present the next session on 109. Let's listen to her and get enlightened. Welcome, Pratima.
Thank you, Nandini. Am I audible? Okay, great. I'm going to be discussing in my session today on India's 109. And before I share my deck, I will give some background to the standard. while it is 109, I want to cover the broader spectrum of a financial instrument, which will also include aspects of 32, which is on the financial liabilities classification. And as Nandini mentioned, it's been 13 years, and maybe Ind AS came in, say, 2017, but IFRS has been there since then. And ever since I've known people, when it comes to the topic of financial instruments, they've either dreaded it or ignored it. I haven't known of a situation where, people go up to, uh, confidently say that, oh, we can talk anything about financial instrument standards. It's very rare that happens, and which is why I specifically chose this topic, because to me, if you break it down into simple aspect, it is probably not all that complex or something we need to dread to. So my aim is, at the end of my session, we're all more comfortable with the topic of financial instruments, because I would have probably broken it down into simpler concepts. Okay. Is my slide visible? Nani, I can't hear you, but I can see if you show a thumbs up, I'll know that my slide share is seen. Okay, great. Okay, so we'll start with the topic. We will first get into the scope of what a financial instrument is. Let us classify a financial instrument into two primary categories, which is a financial asset and a financial liability. Now, when we have something like a financial liability, there is a further subclassification that comes in, whether it is a financial liability or equity. We will come to that part of it later. First, let us just stick to what a financial instrument is. And for simplicity's sake, we will say it's financial asset and financial liability. Now, in very simple terms, if there is a contractual arrangement which gives right to potential cash flow in future, whether it's cash inflow or cash outflow, it is most likely that it will meet the definition of a financial instrument. Now, if there is a contractual arrangement which will result in an outflow of a cash, or say a cash equivalent also, that is what will broadly fall under the definition of financial asset. And that's a very simple way of saying. So if you have an instrument, or if you have any caption, or if you have any arrangement, if the end result of it is that you are going to have an inflow or outflow of cash, it is most likely that it's falling under this standard. And if it is any other way, it will not. And before I get into the definition, the reason I'm trying to spend so much time on what a financial instrument itself is to simplify what the standard is. And I will give an example of how it is. Say trade receivables or debtors. Now, if you have a debtor as of the balance sheet date, or a trade receivables, you know that you have a contractual right to collect cash flow. So if you have trade receivables or debtors for 100 rupees, you know on the date on which it is due, there is a unconditional contractual arrangement to go collect 100 rupees from your customer, and therefore trade receivables is a financial instrument. And because trade receivable will come on the asset side, therefore it is a financial asset. Now take another scenario where you have paid advance to your vendor to purchase goods after 6 months. Now in this case, what has happened is you have a contract where you've given advance to your vendor. That also comes on an asset side as advance paid to vendors. Now the evaluation is this a financial instrument or not? In the case of an advance, you have a contractual obligation. You have a contractual right because you paid the money to the vendor. But the contractual right is to receive services or goods at the end of 6 months. Your contractual right is not to receive the cash flow. So therefore, in the case of an advance paid to vendor, most likely it wouldn't meet the definition of financial instrument, because the contract is going to end by either receipt of services or receipt of goods. So you get the primary or basic understanding of what would typically fall under the financial instrument standard. Now coming to the definition. Now, financial asset. And what falls under financial asset? Financial asset is cash, equity instrument in another country. So, okay, first we'll go cash, very simple. Equity instrument in another entity, very simple. If you are holding an investment in another entity, there are scope exemption. I've covered it in my slide. We will come to it. Contractual rights to receive cash or another financial asset or to exchange financial asset or liability under potentially favorable conditions. Leave the last part, it is unnecessarily confusing you in English. Go back to my definition where I said, where you have a contractual right to either receive cash or another financial instrument or a cash equivalent. It will fall under this definition. Certain contracts which is likely to be settled in entities' own equity. Now, if you have a contract where you are going to settle it in your own equity arrangement, and again, we will cover examples of this in the coming slide, that will fall under the arrangement of a financial asset. Even on this, there are certain scope exemptions, like certain contracts which get settled in an entity's own equity. For example, share-based payments, it is already covered in another standard and therefore wouldn't fall under the scope of 109. Now coming to financial liability. What is financial liability? Contractual obligation to deliver cash or another financial asset in exchange of instruments under potentially unfavorable or exchange instruments under potentially unfavorable condition. So forget the last part, that is English. I will give examples and simplify that. For now, keep the very simple part where you have a contractual obligation to deliver cash or another financial asset to settle your outstanding liability. The next aspect is where certain contracts settle in an entity's own equity. Now, for example, if you, again, there could be complexities in this, which I will cover, but an example of a contract that gets settled in an entity's own equity, which could be a financial liability, says a convertible preference share. If you have an instrument which is a convertible preference share and your conversion ratio is variable, then in that case, it's a contract which will be settled in an entity's own equity and therefore fall under financial liability. Okay, so in both financial asset and liability, if you see the first three aspects of financial assets definition and the first aspect of financial liability, it still goes back to my point where it's cash or anything related to cash or something that will get settled in cash will fall under the financial instrument standard. Now coming to equity. In a financial liability, I mean, if you have a liability, if it is not a financial liability which will fall under the first two definitions, then it's an equity. We will get to examples on how to classify a liability as either a financial liability or equity. Now, there are a couple of examples. Which of the following are financial instruments and which are not? Now, forward exchange contracts, there are three things given over here. I will talk through my thought process basis what I have told in the earlier slide, and we'll look through if it meets these definitions or not. So there are three things here. I have forward exchange contract, I have cash settled share-based payments liability, and I have deferred tax liability. Now, we'll come to whether it gets covered under 109 or not later. For now, let us just go by the logic of whether it meets the financial instruments definition or not. Forward exchange contract. Now, typically, forward exchange contract is a simple scenario where you have a receivable of $100. You fix the rate with the bank. On the date of maturity, when you're going to collect that receivable from your customer, you will give $100 to the bank. The bank will give you back INR at the rate with which you fixed and taken the forward contract. Now, in the entire discussion of a forward contract between you and the bank, you're expected to give $100 to the bank, and the bank is supposed to give you back the equivalent INR amount. Yes, it is a financial instrument, and under financial instrument, it will get classified under the category of a derivative. How we account for derivative is also something that I will cover in this session, but a forward exchange contract is a financial instrument. Coming to cash settled share-based payment. Cash settled share-based payment, very straightforward. The accounting under IFRS 2 or Ind AS 102 is that when you have a cash settled share-based payment, you will account for it as a liability. You will debit your share-based payment expenses and you will credit your liability and you'll keep remeasuring it at every balance sheet date. The logic is that such share-based payments are going to be settled in cash as the name itself suggests. So for the purpose of definition, yes, it is a financial instrument. However, share-based payment as a concept doesn't fall under the scope of 109. Share-based payment gets covered under 102. Deferred tax liability. Now, the concept of deferred tax liability is you create a deferred tax on any timing difference between your actual cash, your actual tax and whatever is your tax profits and your book profits. Now, deferred tax liability comes under the concept of accrual, and this is just an accrued entity. your deferred tax liability will get reversed as your timing difference reverses between your book profits and your tax profits. This doesn't get settled in tax, and therefore deferred tax liability is not a financial instrument. Okay, so that's exactly what is covered here. And as I mentioned, certain financial instruments are excluded from the scope of 109 very specifically. Investments in subsidiaries, associates, and joint venture. If you go back to my definition of financial asset, I said equity instrument of another entity is a financial asset by virtue of definition. However, if you have an investment in subsidiary, associate, or joint venture, doesn't fall under the scope of 109. That is because there is another standard which is including it in its scope. 110 includes it, or 27 or 28 includes it. Employees' rights and obligation for employee benefit plans. So now if you are an employer, say you have an employee benefit plan like a gratuity or a leave encashment, where it will get settled in cash. So you have a contractual obligation to settle it in cash while it meets the definition of financial liability, doesn't fall under the scope of 109. Reason being, there is another standard which is 19. Likewise with share-based payments, rights and obligation under insurance contracts, that's covered by a separate standard. And leases as a concept is covered by IFRS 16 or Ind AS 116, except for the points where you have a receivable as a lessor or finance lease payable as a lessee. Those cases, 109 still covers it, wherein most likely in both these cases, you will be carrying it at amortized cost. We will get to the accounting once we get to it. Let us just look at the scope exception to make it very simple. If something meets my definition of cash settled or cash received, and is not included in 109, is for the sole purpose that there is another standard that is already talking about it. Moving to the next point. On classification and measurement. Don't get confused by this big flowchart. I will speak through on the concept and then bridge back on how this big flowchart covers it. I think, and here is the part where financial instrument actually gets little confusing, or people start getting afraid of the financial instrument standard. So now that we are covering, so we have identified what a financial instrument is. We know the difference between a financial asset and a financial liability so far from what we've discussed. Now coming to the point where how do you classify, and then there will be next on recognition measurement. Coming to classification, we will pick up the topic of a financial asset. Okay. Whilst we will go through this, the classification, the reason why we do a classification is because we need to understand under which bucket a financial asset will fall, so that the subsequent measurement of that financial assets can follow from there on. Because for initial recognition purposes, every financial asset will always be measured at fair value, regardless of what its nature is or regardless of what its classification is. So by rule of thumb, and as per 109, if there is a financial instrument, its initial recognition is always at its fair value. Subsequent measurement of how the financial asset works will happen basis the classification. Now, for classification, we have 3 categories, and I'm sticking to asset for now. I will come to the liability part later. Even an asset, let us exclude equity instruments. I will cover that subsequently, because if I take everything at one time, it will get clustered. So I will cover equity in the next slide. For now, let us take financial assets, which are non-equity instruments. Financial assets that are non-equity instruments can fall under 3 categories. 1, it could be carried at amortized cost. And amortized cost, as fancy as the word sounds, it is nothing but the cost. So it is the cost of the instrument at the value of the. So for example, if your trade receivable is 100 rupees and you're going to recover that trade receivables after 60 days, the amortized cost of the trade receivable is 100 rupees. Where the reason why it's called amortized cost and not just cost is because, say you have a trade receivable or a debtor of 100 and you're going to collect it after 2 years, then there is an imputed financing element involved in it. So you may have to discount it and account for it. And that's the reason why it uses the term amortized cost, because if your debtor is 100 how the standard looks at it is that if your debtor is 100, you're going to collect it after 2 years. There is an implied financing. That is it's like an implied loan that you've given to your customer by giving him a 2-year credit period to be able to repay you. And which is why towards that implied financing component, you have to quantify that and separate it from the debtor. So what it will be that, say, for instance, you split that 100 as 80 is towards debtor and 20 is towards the financing, implied financing, which you've given to your customer. That 20 will not be a part of your debtor. That 20 will go into P&L as interest accrued. I mean, that 20 is the deemed interest, which goes on the receivable, and the 80 is your actual debtor towards the sale of goods or services. That's the reason it uses the terminology amortized cost. This is not a very frequent industry practice, but yeah, so don't get confused by the term amortized cost. So the first one is there are 3, as I told you, coming back, financial assets, which are non-equity instruments, 3 categories, amortized cost. Second one is the terminology used as FVTPL, that is fair value through P&L. And the third one is FVOCI, which is fair value through other comprehensive income. And I'm just reasonably assuming that we know what other comprehensive income is. And I'm not going to be spending too much time because 109 by itself is a very big topic. So there are three classifications. Now to see how each of these will fall under these 3 classifications, what are the tests or what are the conditions that need to be satisfied? So there are 2 concepts which the standard brings in. One is the business model test and the other is the cash flow test. Okay. So the order of preference is, first you do any financial asset, non-equity instrument. You first do the cash flow test, then you do the business model test. And basis on your answer of the cash flow test and the business model test, you determine what is the classification of that financial instrument. When I say what is the cash flow test is what is the nature of your financial instrument. Is your financial instrument or your financial asset of the nature where you're going to get specified cash flows that are solely payments of principal and interest that are outstanding? And I will give you another example of what it is. If company A gives a loan to company B, again, we'll stick to 100 for mathematics simplicity. If company A gives a loan of 100 to company B, charges an interest of 10% and says that this has to be repaid back over a period of 10 years based on EMI computation, then in that case, in company A's asset who has given the loan, the cash flow test will be met because you've given 100 rupees. You're going to get interest at 10%, which is fixed and known, and you're going to get back your EMI over a period of 10 years. So you have a financial asset which is arising, and there are specified dates of cash flows, which are solely your payments of principal and interest. Okay. The standard uses the term SPPI, and you will hear this very often if you listen to any IFRS discussion. And SPPI is solely payments of principal and interest of the amount outstanding. But to make it very simple, if your cash flow is known on day one and you know when you're going to get that cash flow, then the cash flow test is passed. Don't get confused by the wordings. The logic is very simple. If you know how much money you're going to get and you know when you're going to get that money, your cash flow test is passed. Coming to the next one, which is the business model test. Business model test is to test and see what your business model is. Is your business model to hold the financial asset to collect the contractual cash flow at the end of the term, or is your business model to hold it for trading? Okay, that is the question of or is your business model a combined one where you may hold it, you may trade it, depending on how the market works. So depending on what your business model is, the next step will follow. So 2 concepts very clear. First step, always do the cash flow test. Cash flow has this fancy term SPPI. That's what the standard called. For me to further simplify, it's nothing that do you know how much money you're going to get and do you know when you're going to get it. That is SPPI. Second, business model test, where you need to evaluate what is your business model. Are you going to immediately give it away? Are you going to hold it till the end of its term? Or you are confused and you don't know, you may do either depending on how favorable the terms are. These are the 3 categories. Now, the next one, the standard just puts it to complicate things further. There is a third, which is a sub-test where it says you designate a financial asset by yourself at FVTPL. So if you by yourself have gone and designated a financial asset at FVTPL, because you may have a corresponding financial liability for it, which is also at FVTPL. So to avoid accounting mismatch, you account both at FVTPL, then you're permissible, but that's an option which is given. And out of all the years of experience, nobody avails this option. So coming to my first two tests, okay? So now we'll come to basis the first two tests on how do you classify it. So, okay, so we'll pull the easier one out. So there is an option to classify financial asset as FVTPL. If you elect that option by default to FVTPL, no need to do other cash flow business model, etc. But if you don't elect it, is where the actual reality comes in. So there, how do you do? So take the first scenario where your cash flow tests pass. That is, with your asset, you know how much money you're going to get it and when you're going to get it. And the second one where your business model test pass. That is, by pass, I mean your intention or your business model is to hold to collect the contractual cash flows that will arise from this financial asset. So when your cash flow test passes, your business model test passes, your financial asset are classified as at amortized cost. And your subsequent measurement will always be at amortized cost. Take my example of trade receivables, where before starting, I told you trade receivables is amortized cost. You have a debtor of 100, which you're going to collect after 60 days, you know. So that debtor of 100, you know it's 100 rupees, you know you're going to collect the 100 rupees after 60 days. And the standard for you to imply an interest, it gives you a period of 12 months. So if there is anything less than 12 months, it doesn't make sense in charging or notionally applying any interest concept. So which is why in the concept of 60 days, you have a 100 rupee debtor. You're going to collect it after 60 days. It satisfies your cash flow test. You know how much money you're going to get. You know when you're going to get it. Second, what is your business model? Is your business model to wait and collect the debtor at the end of 60 days? Or is your business model to go pledge that debtor, get it refinanced, give it to someone else? Most likely, the intention or the business model of every company when they have a debtor is to hold that debtor and collect it after 60 days. So even the business model test is met. So in the case of a trade receivable or a debtor, both the cash flow test and the business model test is met, and therefore it is carried at amortized cost. Okay. Now coming to the next category. Now take a scenario where your cash flow test fails. If your cash flow test is not passing, that is, you do not know when and how much cash flows you're going to get, then by default, you go into the FVTPL category. So you have an asset, which is a financial asset, and you do not know. So take, for example, mutual funds. Okay. You have an investment in mutual funds, and we all know mutual funds are subject to market risk. So you have an investment in mutual funds, the value of which keeps fluctuating. So you might have invested 100. Tomorrow it can be 120. Day after tomorrow it can be 75. It depends on the net asset value of the fund in which, the investments in which the fund in which you have invested has made. Now that fails the cash flow test. While you know how much money you've given, you don't know how much you're going to get and when you're going to get back. So it has failed my cash flow test. By default, an investment in mutual funds would fall under the FVTPL category. Till here we are clear. Now coming to the next point, business model test. If you failed your cash flow test, you straight go into FVTPL. Now come to the business model test. If you failed your business model, if you've passed your cash flow test, now we'll come. So if you know you're going to get specific payments of principals and interest over a period of time with your financial instrument, now you come to the next point. What is your intention? Is your intention to hold on to it and collect it only on its maturity? Or is it to keep selling it or trading in it? Or is it to see what is favorable to the market? So if your business model test is not met, if your cash flow test is met and business model test is not met, then it will still go into FVTPL. I know there are 2 stars on my presentation. I will definitely cover it, but for us, let me follow the flow of thought. So if the cash flow test is not met, by default FVTPL. If the cash flow is met, business model is not met, then also FVTPL. There is an exemption. I will come back to it and cover later. And then coming to the part where if suppose the cash flow is met, business model is met, but you still choose to designate it as FVTPL, then also it is FVTPL. Now coming to my third option, which I said is fair value through other comprehensive income, which is FVTOCI. Here in this case, where your cash flow test is passed, that is, your principal and interest will be collected over a fixed period of time, but your business model is uncertain. That is, you may sell if you think it is favorable, or if you require cash at that time, you might sell it. Or if you don't require cash, you might hold it to maturity. If your business model is flexible in both ways, then you have an option where you will which is called fair value through other comprehensive income. That is, at each balance sheet date, you will be measuring the fair value of your financial asset, and whatever is the gain or loss in that fair value, you will be taking it to other comprehensive income. This amount will be recycled from other comprehensive income to P&L when you sell your asset. When that asset is disposed, derecognized, at that point, this amount will be reclassified from other comprehensive income to P&L. The logic for taking something to other comprehensive income is that you want to evade the volatility in your P&L. Because here in this case, your business model to hold a financial instrument may vary, and therefore the fair value changes in your financial asset doesn't necessarily represent your business operation, which is why it may not be absolutely fair to add the gain or reduce the loss from your P&L, which is why the standard gives you an option to take it to other comprehensive income, keep it in other comprehensive income, but take it back once you have derecognized or disposed the asset. Because once you've derecognized and disposed the asset, then there is no point holding it in OCI further till the end of time. You take it back to your recycle it back to your P&L. That is the concept. Okay. So we are hopefully clear on the three parts of the amortized cost: fair value through P&L and fair value through other comprehensive income with recycle to P&L at the time of derecognition or disposal. This is the first part of classification or subsequent measurement of financial assets, which are non-equity instruments in nature. Coming to this was the FVTPL part, which I mentioned, to avoid an accounting mismatch, where I said if you have a financial asset and you have a corresponding financial liability, which you are anyway going to be measuring at fair value, so you opt to measure your financial asset also at fair value to avoid the accounting mismatch. Now coming for investments in equity. So I told you my first classification, where I explained cash flow and business model test, and I classified into three parts of amortized, FVTPL, and FVOCI with recycle to P&L, was for financial assets which are not in the nature of equity instruments. Now I'm covering financial assets which are in the nature of equity instruments. Here in this part, where you have an investment in an equity instrument, which is held for the question here again is that when you have an investment in an equity instrument, by nature of the fact that it's equity, it will fail your cash flow test. Because say you have invested in the equity of another company, you don't know when you sell that share how much money you're going to get. It will fail the cash flow or the SPPI test, where it is for the sole payments of principal and interest. Equity is not for that nature. So by virtue of failing the cash flow test, ideally a financial instrument should directly be FVTPL. But in the case of equity instruments, standard allows a subclassification only if it is an equity. So by virtue, if I go back here where it says this is an SPPI test, so I said the first test is cash flow test. If you fail your cash flow test, by default your FVTPL. Any equity instrument will always fail the cash flow test, and which is why it should be FVTPL, but the standard allows an option. Whereas ask the question, what is the intent of the equity? Is your intent to trade in equity? That is, are you investing in equity so that you can trade where it's quoted, you can trade? Then in that case, you have to by default go and do FVTPL. There is no other option to you. However, if the investment in equity is not for trading. For example, some companies where they have a certain cooperative societies added, there is a mandate that they have to have shares of some 5 or 7% in that cooperative society. Now, that investment in that cooperative society shares, although it's in the nature of equity, but the intent is to never trade in it, but it is to hold it for maturity. Then that such an instrument would fall under this scenario, and there the standard permits you to carry that investment at FVOCI. That is where you take the fair value of that changes in the equity at each balance sheet date through other comprehensive income, which is exactly what it says. If there are any changes in the fair value of that equity instrument, you take it to other comprehensive income. If there are any dividends, then you take that to P&L. The reason why you take something, go back to my logic, the reason you take something to other comprehensive income is because the fair value changes of that particular financial asset should not reflect on your performance of that company. Which is why if your business model is not to trade, or if your intention is to not to trade in that equity instrument, but just hold it forever, then it may not be necessarily rightful to impact the performance or the P&L of the company with the change in the fair value of such an instrument, which is why the standard gives an option where your equity instrument is not held with the intention of trading. That is, you're holding it just for the purpose of holding it to as an investment till the end of time. Then in that case, you have an option to take it to FVOCI, and any changes subsequently is recorded in OCI. And now this OCI, the difference from the earlier OCI is that when an equity instrument is classified as FVOCI, this is without recycle to P&L. So if upon sale of the equity, the impact in the OCI will not be recycled to P&L. Instead, it will be taken directly to reserves. It will be taken to other equity directly. It won't be routed through P&L. The same logic. Your intent was never to carry out a business with this subsidiary. Therefore, don't impact your P&L with it. Whatever fair value changes, take it to OCI. And if at all you sell it, move it directly to the reserves. Okay, so I have covered financial asset part of it, which is the toughest part of the standard. And this gives me an absolute sigh of relief because the most difficult part of the standard I have covered now. Now coming to this, the next few slides, I'm just going to be deliberating a little more on what is business model, what is cash flow test, etc. And whilst I've already explained it in detail, I'm going to be skipping quickly through these slides. So the logic of a business model is the intent of the company on what they're going to do with the financial asset. This decision can be taken at an asset portfolio level. So I might have one particular business model for the loans which I give. I might have another business model for the investment in equity instrument. I might have another business model for the investment in traded debt instrument. So it can happen at an individual portfolio level. The company needs to define what its business model is, whether it's to hold to collect it or to trade in it, or it could be a combination of both. Second is the contractual cash flow test, that is the SPPI test. I have put it across very simply, while this slide uses a lot of English words. The simple aspect of a contractual cash flow test is that do you know how much money you're going to get, and do you know when and all you're going to get that money? So if that is defined, then in that case, the contractual cash flow test is passed. Now coming to classification of financial liability. I don't know if the questions or chat box is on, but then we can probably take it at the end of the session, and I'm also running out of time. So I am going to go to financial liability, but if there are questions on financial asset, I will take it. Coming to the classification of financial liability. Now, again, this slide may not look very simple, but just follow on with me. I will simplify it and make it a little more user-friendly. So, and this is not a slide which I have made. This is a slide which the standard has made. So again, now coming to the logic of whether the financial liability is held for trading. If you look at the entire classification principles in the financial statement standard, it follows only two basic concepts: the business intent of the company and the nature of cash flows. That is what determines how whether it is fair valued or carried at its cost, or whether the fluctuation in fair value go to P&L or go to OCI. So the two main questions at any aspect are how the cash flows are structured, and another is what is the intent of the company. Now, coming to the classification of financial liability, if we have a scenario where whether the liability is held for trading, uh, the same question, the business model, whether liability is held for trading, and the second one is whether the liability is designated. So every financial instrument under the IFRS 9 or India's 109 standard has an option to elect it for a fair value through P&L. But however, if it is selected, then by default it goes through P&L. But if it is not selected, then in that case, we go to the next question, where does the financial liability have an embedded derivative? I have examples covering what an embedded derivative is, but to make it little simple, say you have a debenture which can be converted into an equity instrument of the company. So if you have debentures which are issued, and those debentures can be converted, which are optionally converted to equity, then in that case, your underlying debenture is a liability, but the option to be able to convert it is an embedded derivative on it. I will cover embedded derivative and derivative accounting in my subsequent slide. For now, I'm going to speak only of a financial liability classification. And financial liability classification, unlike a financial asset, is a little simpler, where for a financial liability, if you know how much money you're going to pay out and your intent is to pay only at those specified times, then in that case, it's measured at amortized cost. In any other case, it is measured at fair value through P&L. We will come to embedded derivative accounting in subsequent slides. So now let's just take this example here, where Leela Tech invests in a zero coupon bond. The bond bought at a price that is lower than the nominal value, which is repaid at maturity and which does not give rise to periodic interest payments. The nominal amount of the bond is 100. The purchase price is 80. The directly attributable transaction costs are 4. Uh, give, Given this case, this company has classified it as amortized cost. Now let's just take a step back and see whether it meets the criteria for amortized cost. So the first test of an amortized cost is the cash flow test. Now, in the case of a zero coupon bond, the bond does not the interest is known and the interest is zero, which is why it's called a zero coupon bond. Coming to the next part of the payment of principal, it is certain that 100 rupees, that is the nominal value of the bond, will be collected upon the end of the term. And in the first point, it very clearly mentions that the intent is to be able to hold it till the end of time, and which is why they have classified it at amortized cost. Now, coming to the point of what is the value at which you will determine or recognize the zero coupon bond. Here in this case, 80 rupees is the price at which, assuming it's an arm's length transaction, and which is why 80 rupees represents its fair value, the value at which you acquired it. And 4 rupees is the transaction cost. The standard allows you to capitalize or add the transaction cost to the value of the financial asset. So the bond will be carried at 84 rupees. This is just a recollection of whatever I mentioned earlier: amortized costs, subsequent measurement, FVOCI, equity investments at FVOCI without recycle to PNL, and FVTPL. Now coming to amortized cost, where I'd mentioned that where I'd initially kept it simple by saying if something is amortized cost, it is most likely going to be just the cost. There could be the reason why they use the term amortized cost is because the standard brings in a little more complicated term that's called the effective interest rate. That is where I had given the example, say, where you have a receivable of 100 rupees, where you may collect the receivable after a 2-year period, and which is why that 2-year period is considered as an implied financing which is given to your customer. And there could be a notional interest. So you'll split the financial instrument into what is the cost of the receivable and what is the deemed interest that it carries. We will move on to the topic of derivatives and embedded derivatives. First, we will speak on what a derivative is and how the derivative is classified. So a derivative, basically, by the term itself, what it indicates is every derivative is a financial instrument without any doubt. What a derivative, by the term itself, as it suggests, a derivative is a financial instrument which derives its value from an underlying. So in my first example in the initial slide, I'd given the example of a forward contract. So where you have a forward contract, and the forward contract, say it's a forward contracts on receivables. So the forward contract would derive its value from its underlying. Say a forward contract is for converting USD to INR. It derives its value from an underlying, which is the USD currency, where there is no or very little net initial investments. So for any derivative, these are the three characteristics. The values derived from its underlying, there is no or very little net investment, and it is settled at a future date. So my forward contract example perfectly fits into it. The contract derives its underlying from an exchange rate. There is very little or no initial investment, and typically a forward contract is settled at a future date once the collection comes in. So here are a few examples of what are examples of derivative and what their underlyings are. So in an interest rate swap, that is where you have where your interest payments, say, are made at variable rates. You may have a swap to curb your interest payments to a fixed rate. So in that case, your interest rate is a variable. If you have a forward exchange contract, as I said in my example, forex rate is the underlying. In a commodity option, the commodity price is the underlying credit default for the credit risk. And in a written stock or a put option, it's the equity price. Now coming to how derivatives are accounted for. Let us go by the simpler approach for classification of derivative. By default, every derivative should be classified at FVTPL, and go back to the very principle or basic logic which I had explained of 109. That is, you have to see whether you know your cash flows or not, whether you know what the cash flow is going to be and how much it is going to be settled at. Most likely in the case of derivatives, the value is not known at the inception of the contract because it derives its value from the underlying. So, which is why the derivative will fail the cash flow test, and by default, all derivatives have to be classified at FVTPL. However, there is an exemption which is given in the standard, which is called hedge accounting. And I will be covering that in my subsequent slide on what is hedge accounting, what needs to be considered when you do hedge accounting, and what is the option that is available for accounting for derivatives under the hedge accounting. So with respect to derivatives, which are non-hedge accounting, the accounting is very simple. It's FVTPL, fair value through P&L. Coming to embedded derivatives. Now, with respect to embedded derivatives, there could be a situation where there is a host contract and there is a derivative which is embedded on the contract. Go back to the example which I had initially given you. Take the case of an optionally convertible debenture. The underlying is a debenture, which is the host contract. There is an option to convert it, which is the embedded derivative on the contract. Now, in this scenario, what the standard mentions with respect to accounting for an embedded derivative is that one needs to evaluate whether the embedded derivative can be separated from the host contract. Is the terms of the derivative independent of the host contract? Then the derivative is separated. The host contract is accounted as per whatever is the principle of Ind AS 109, and the derivative by default will go to the accounting of FVTPL. I'm going to skip the examples of what the derivatives are because I'm running out of time. So this is the concept which the standard speaks of and which I had explained. When there is an embedded derivative on a contract, see if the embedded derivative can be separated basis the terms and the definition. We will take my very example of a convertible debenture. If you have a convertible debenture that can be converted into, there is an option to convert it, and the option is to convert it into the equity shares of the company. Then in that case, you evaluate and see whether the option to convert to equity shares of the company and the terms to convert it, do they have any nexus to the value of the underlying debenture? So if there is an underlying debenture where you know that the term of the debenture is say for 10 years, it carries an interest of 10%, which fairly represents the market interest rate. You have an option to convert it to equity, the equity shares of the company. Then in that case, the option to convert it to equity shares of the company can be separated to the underlying debenture, which has independent terms of its own. In such a scenario, the option to convert is an embedded derivative that is separated from the host contract, which is the debenture. That embedded derivative will be accounted for at FVTPL, and the host contract will be accounted for under the principles of IFRS 9 or Ind AS 109. Coming to the concept of hedging. Now, hedging, as the name suggests, as the word hedging suggests, you hedge those aspects where you have an exposure. So if I'm a company in India and all my expenses are in Indian rupees, if I have a receivable in dollar, then I have an exposure to foreign currency. That is how rupee performs as against the dollar will determine how much cash flow I'll get against my $100 receivable from my customer. So the $100 might be fixed from the customer, but at what level that $100 will be settled by the customer is an exposure. So if there are any instruments or anything that is done to be able to protect the company from that exposure, that activity is called hedging. Now, with this basic example, what could a company typically do to protect itself where it has a receivable of $100? It is that it should be able to take a forward contract. Now, if a company takes a forward contract for the same 100 rupee value, what will happen is that the value of that 100 rupees on date of taking the contract will be fixed. Say it is fixed at 70 rupees. Now, subsequently, on the date of settlement of the contract, regardless of how the dollar performs to the Indian rupee or the Indian rupee performs as opposed to the dollar, the company's cash flows are fixed at that same 70 rupees, and therefore the foreign currency exposure of the company is hedged. This is a very simple and basic accounting or the concept of how hedging works. Now, coming to this, in my example where I told the foreign currency exposure, and to hedge the foreign currency exposure, the company takes a forward contract. This forward exchange contract is in the nature of a derivative. But the underlying intention of this derivative is hedging. That is, the company wants to avoid fluctuation in its cash flows. In such a scenario, what the standard allows is that although by logic, I have covered all of this. Yeah. So what the standard allows is, although by rule of thumb, derivative needs to be valued at FVTPL, but if the intent of the company is to hedge and there are certain other conditions which I will be covering, if those conditions are satisfied, then the company can recognize the derivative at fair value through OCI. So if the intent is hedging to only protect the cash flow, the company has an option to adopt the hedge accounting, where in such a scenario, that derivative can be classified at FVOCI. So this goes through what is a hedging instrument and what is a hedged item, which I just explained. So a hedging instrument, say in my example, was the forward exchange contract. What the instrument that a company chooses to be able to hedge or protect any sort of exposure in its financial instrument is called the hedging instrument. Hedged item is the underlying item which is exposed to a particular risk, could be either currency risk or liquidity risk. In the example I had given is you have a receivable which is exposed to a foreign currency risk, and which is why the hedged item in my example was a receivable. Now coming to the hedge accounting models. For the purpose of hedge accounting model, the standard divides it into three categories: fair value hedge, cash flow hedge, and a net investment in hedges. Now, with respect to the fair value hedge, what is a fair value hedge? With the fair value hedge are those cases where the company, by its intent, is protecting the fair value. And I will give you an example of what a fair value hedge is. Take a situation where a company has taken a loan and the interest rate on that loan is fixed. Now, when your interest payment on a particular loan that you've taken is fixed, but you take an interest rate swap to swap it with a variable interest, what you're basically doing is that you are swapping a fixed rate where your cash flows are fixed against a variable rate of interest. That's because you believe that maybe the fair value or the LIBOR rates in the market are more favorable than your fixed rate of interest, and which is why you take an interest rate swap. Here, what you're doing is you're protecting yourself against the changes in the fair value, and you're not protecting the standard payments of principal and interest, and which is why it would fall under the definition of fair value hedge. Now take a scenario of the same loan where the company has taken a loan, but the interest payments are variable, say LIBOR plus 2%. Then in that case, the company takes a swap to swap its variable interest rate against the fixed interest rates. Here, the intent of the company is to standardize and straight line its cash flows over the period. That would be an example of a cash flow hedge. So the example which I gave where a fixed interest rate is swapped for variable interest rate would be a fair value hedge, but where a variable interest rate would be swapped for fixed interest rate, that's a cash flow hedge. Net investment in hedge is very simple. If you have a foreign operation which generates cash flows that are routed back to the parent, and if there is a hedge that is taken on the forex out of that foreign operation, that would fall as a net investment in hedge, because you're not hedging a particular line item of, say, receivable payable, you're hedging the entire operation. Now coming to classification. One second. We'll go back here. So with respect to the accounting, fair value hedges will always be carried at FVTPL. Cash flow hedge is where the option exists to carry it at FVOCI. So which is what it explains. So if you have a fair value hedge, the end result, as in the trend over here, the changes in the fair value will only affect the profit and loss in the case of a fair value hedge. I'm skipping the case study because I'm running out of time. Coming to cash flow hedge. In the case of a cash flow hedge, the variability in the case of a cash flow could affect the P&L. But in the case of cash flow hedge, and I will come here as it's explained over here, if your cash flow hedge is effective, that is, if it is taken with the intent. Hi,
Shripriya has now joined
Hi,
us.
Pratima.
Hi.
I'm at the airport. Very happy to see you. Please continue.
Okay, great. Okay, so I was speaking of a cash flow hedge. So in the case of a scenario where a cash flow hedge is effective, the reason what standard uses as the term as effective is basically the evaluation as to whether the company is better off by taking the hedge or were they better off by not taking the hedge. That evaluation is to decide whether the cash flow hedge is effective or not. So if a cash flow hedge is effective, it will be taken to OCI, and in any other case except for the cash flow hedge, the derivative will be valued by taking it to FVTPL. Net investment in hedge, as I mentioned, is where an entity has a foreign operation. In such a scenario, what you're hedging is the entire operation. You're not hedging a particular hedging instrument or a financial instrument, say a receivable or a payable. So when the entire operation is hedged, in that case, the similar principles of cash flow will apply. So if a cash flow hedge will apply. So if the entire hedging of that operation is effective, the intent is to hedge it and protect the cash flows of the company, then in such a case, the company can account for it through OCI. To complicate things a little further, apart from just segregating hedges into cash flow hedge, fair value hedge, and investment in foreign operation, for a company to be able to do hedge accounting, i.e., by default, every derivative goes into FVTPL. However, if the derivative is in the nature of a cash flow hedge, there could be an option for accounting for it at OCI only if that derivative is effective. That could be taken to OCI. There is one more layer of complexity where if a company wants to follow hedge accounting, then there are certain other conditions that they need to comply with. Firstly, there needs to be a formal documentation of identification of what a hedging instrument and hedging item is. Hedging instrument and hedging item, for the purpose of recollection, go back to my example where I mentioned that the company has a forex exposure on their trade receivables and they take a forward exchange contract to protect the forex exposure. The hedging instrument is the forward exchange contract. The hedged item is the underlying receivable. The hedge is expected to be highly effective. What it means by the term effective, as I simply specified, the standard says qualitative factors. To make it simple, it is the evaluation to see whether the company is better by taking the hedge or would they have been better off by not taking the hedge. So at each balance sheet date, this assessment is required to be done. And therefore, if the company is in a better position by taking the hedge, then the hedge is effective. Earlier, just since this is a discussion, earlier the standard had a range for measuring the effectiveness of 80 to 125, but now that has been removed. So it is just the qualitative evaluation whether the company is in a better position by taking that hedge or not. Yes, as I mentioned, only a cash flow hedge is eligible for the purpose of hedge accounting, and the effectiveness can be reliably measured, and the hedge effectiveness testing should be done on an ongoing basis. Basis all these criteria, hedge accounting would be permitted, and this can be by permissible hedge accounting, I mean that the fair value changes of the derivative can be taken to OCI, and this would be reclassified to P&L upon disposal of the derivative. I spoke about the effectiveness testing where I said earlier it was 80 to 125. Now it's only qualitative factors. I'm going to speak about derecognition of financial assets and quickly wrap that up with the disclosures because I have already passed time. The most critical aspect on the derecognition of the financial asset is the impairment. The reason I'm covering this is because this is something we largely use in real life. Where in the erstwhile standard or in the AS, any financial asset we used to measure it based on the incurred loss model. So I'll go back to my same receivable example because that seems most relatable for me. So in case of a trade receivable or a debtor, the debtor will continue to be carried at its value unless there is reason to believe that the customer will not be able to repay, or if there is a dispute, then in that case, there would be a situation for a provision for doubtful debts that would be created. This is how the erstwhile standard looked at it, and which is why it was called as the incurred credit loss model, where you give a credit and a credit loss is incurred, then in such a scenario, you account for the provision for doubtful debts. However, in this scenario where the IND AS 109 looks at the concept which is called the expected credit loss model, where the standard requires you to expect what would be the credit loss based on your historic trends of how the receivable or how the financial asset has performed, and create a provision for it on the date of initial recognition itself, and not wait for any incident or a transaction to happen for you to incur that loss. And this is the key change between the erstwhile standard and this standard, where the incurred credit loss has now become the expected credit loss. The standard permits two approaches. One is the general approach and the other is simplified approach to be able to measure it. These are again complex terms, but to simplify this further, these losses are determined based on the past historic trend of how the company's financial asset has performed. So take the same example of my trade receivables. Receivables falling under the similar bucket. What is the history of losses? What is the history of the company incurring losses? That is measured and that is given effect to on the date of recognition of that trade receivable under the new expected credit loss model. I have covered the topic of financial instruments under 109. I have already exceeded the time that was given to me, and which is why I'm not going to be able to cover a classification of liability or equity. I'll probably keep that for the next session, because I also need to keep the floor open for questions, if any. So with this, I will stop my presentation here and leave it open for questions, if any.
Shanu, do we have any questions? Hi, Pratima. Very, very happy to see you here. And I managed to catch the last 10 minutes of your session. I'm at Delhi today on work, and so happened to be at the airport. But it only left me thinking, we've been running these Wednesday sessions, and we've been inviting only women speakers. And across all the Wednesdays that we've run, we're just wondering where you all were earlier. So basis this, I'm sure you're going to get a lot more invites, and we'll be happy to share with you the video recording of this session. So I think it was extremely well done and very, very articulate and consummate presentation, Pratima. Thank you so much for being with us here today. So are there any questions?
So till the Shanu comes up with a question with the permission of a chairperson, let me take 2 minutes from each one's time. And I am really happy that we are successfully running this 23rd Sky High Symposium, and it's it's my endeavor to serve the best to the fraternity of our institute, and specifically this women fraternity, by giving them opportunity to speak, to coordinate and conduct. So it's 23rd Sky High Symposium. So I am really happy, and I really thank Meera as well as Pratima for taking this session in excellent manner. And also Pooja, Ishita, Nandini, all are there to conduct and coordinate and moderate this session. And the support which has been extended by Shri Priya Madam to our chairperson, WMEC, to this thought and the ideas of every Wednesday series, 5 to 7. And generally we see that one technical and one non-technical session we take. And it's a great opportunity. And we again invite all of you to be part of the series and block your calendar for every Wednesday, 5 to 7. So thank you very much, and we'll catch up, and it's time to take the questions, if any, by Shanu madam.
Thank you, Preeti ma'am. I think all the listeners have a thorough knowledge, insight knowledge on the topic, subject topic.
Sure.
Ma'am has explained the topic very well. And
Can I just have it's more a suggestion than a question. Pratima, your session was really insightful and great. As you rightly pointed out in the beginning, it's a very tough topic, and you tried the maximum to dissect it for us in a very good manner. Just a suggestion, because people who are attending these sessions are already qualified chartered accountants, I just thought if 109 could be explained more with examples, in the sense that more on a practical level, because you have experience in actually looking into balance sheets where you would have applied 109 and the various aspects of the standard. So I thought if you could have brought us more onto those kind of aspects. Aspects level probably when it comes to practical level, FVTPL, how do you actually do a fair value? Where do you look for a fair value of a particular item, and how do you go about it? Might be again a thing which is like, okay, how do you actually start doing this? Those kind of things could have got like settled down if you can explain us more on those aspects. So that was just a suggestion. Thanks for the session anyway, it was great.
Thanks, Nandini. Actually, this was only a 40-minute session, and it was intended to be an introduction. So maybe we could do this in the further sessions. The topic assigned to her was to introduce the theme itself. So, but thanks very much. Thanks for being here, everybody. And it's over to the formal vote of thanks.
Thank you, ma'am. I hope all have enjoyed listening from today's learned speakers, CA Meera madam and CA Pratima ma'am. On behalf of Women Member Empowerment Committee of ICI, I extend my formal vote of thanks to our beloved speakers. Thank you, Meera ma'am, Pratima ma'am, to throw light on the today's subject topic. Thank you, Shripriya ma'am, Preeti ma'am, for giving us the opportunity. Thank you, madam, for your valuable time and sharing knowledge with our members. Secondly, I extend my formal vote of thanks to all the members present virtually for their patience listening. I am thankful to the Women Empowerment Committee, CA Preeti ma'am, to give me the opportunity to extend my vote of thanks. I thank all the technical team members to provide seamless platform for conducting the meeting smoothly. Thank you all. Thank you once again. Have a nice day.
Thank you, Pooja. And in spite of small baby, you are here to coordinate and being there. It's a really nice time. So thank you very much. Thank you, everyone.
Thank you.
Yeah.
Thanks, baby.
Thank you.